Hi, my name's Riz Malik, Director of R3 Mortgages, and today I will be looking at the possibility of the UK moving to negative interest rates. So where are we now? It's been reported that the Bank of England could be changing their stance on negative interest rates. Now, the base rate is already at a record low in the United Kingdom. In March, on the 20th, we went down from 0.75 to 0.25, and then it went down to 0.1% thereafter. And that's the level that we're currently sitting at in the UK. And just to put this in context, in June, I turned 40. I know you can't believe it, but you haven't met my wife, so it would explain the grey hair popping up in my beard. In June, I turned 40, and in June of 1980, the UK base rate in the United Kingdom was 17%. Okay, and now there is the possibility that rates could go negative for the first time since the creation of the Bank of England back in 1694. So what is the base rate? So look, essentially it's the cost of banks borrowing from the central bank, which in our case is the Bank of England. The rate itself is set by the Monetary Policy Committee at the Bank of England, and essentially the base rate is a tool that's used to keep inflation within certain parameters set by the UK government. The Monetary Policy Committee usually meets at the end of the month, a number of times during the year, and that's when they take the decision by looking at the economic indicators and factors out there as to whether they should keep the rates where they are, whether they should increase them or decrease them. However, they're not restricted to these set meetings, as we saw during the recent COVID, the breakout of the recent COVID pandemic in March. They can change the base rates more frequently if they feel that they need to do so, especially if they feel that they need to intervene in times of economic turbulence. So why would negative rates be used? Well, rates could go into negative territory if the Bank of England feels that they need to stimulate the economy further and essentially prevent a deflationary spiral in the United Kingdom. They would do this as a tool because essentially they don't want households and businesses sitting on piles of cash. They want the money out there in the market and the funds spent rather than sitting in savings accounts. So let's just put this all into context. Even during the previous economic downturn that we had, the credit crunch 2007, interest rates in the United Kingdom did not go into negative territory. But this isn't uncommon, and negative interest rates have been used by other central banks in parts of Asia and Europe as well. So this isn't the first time that this has ever happened globally. So what do negative interest rates mean for us? Now, if you are a borrower in a negative interest rate environment, lenders could pay people to borrow money. Okay, remember, it depends on how negative the rates are. We're currently at 0.1, 0 is here, so it depends on how left you ultimately go. But in that scenario, lenders could pay people to borrow money. In Denmark, for example, there are some mortgage products where, because of the negative interest rates, your mortgage balance decreases by more than your monthly payment. Okay, it is possible. On the flip side, for savers, what does it mean? Well, it could mean that it costs you, okay, it could cost you to hold money in the bank, okay? Having money in a bank, in the UK especially, we're used to this notion, well, if I put £10,000 with a bank, they're going to pay me a return for the privilege of having the money. And they do that because of credit creation and them only holding a certain proportion of that money and hypothetically lending out the rest of it. However, the costs of storing money in a bank are there. There's the security cost, the transportation costs, the storage costs themselves, the administration of the staff, etc. So it could be a case where if you want to deposit money physically in the bank, you have to pay the bank for the privilege. Or you might say in that scenario, well, I'm not going to pay a bank to hold my money. You might take it out. What are you going to do? Take it out. Put it under your mattress. Burglars are going to be, rubbing their hands with glee if everyone's going to be taking out cash and putting it in the mattress at the end of the day. So that could happen. In the UK, is that likely? Personally, I don't feel that, especially on the debt side, that is likely anytime soon. For example, the Danish model that I've just been describing, but ultimately it will dramatically reduce the borrowing costs or the costs for you taking out a loan. Lending is still a business, so the banks will still need to make a profit, and they may do this by, in the case of mortgages, for example, increasing the setup costs. So, for example, the arrangement fees of a mortgage, as opposed to taking or making their money by holding the debt for a long term. Now, there is also the argument that if borrowing is cheaper because the cost of borrowing has gone down, and assuming that the lenders are still lending, and due to the economic environment, lenders don't take a cautious approach and restrict the lending, their lending criteria, for example, cheaper borrowing could increase property prices. Cheaper borrowing costs could increase property prices. And this is because if there's a greater availability of funds at a lower amount, making it more affordable, and in the housing market there's only a limited amount of supply of stock on the market at any given time, and an increased number of potential buyers in the market, that could start pushing up the prices as the demand outstrips supply. So where a lot of the press recently has been on the movement downwards of the property values, some have said 5%, some have said 10%, depends on who you read and on what day you read. In that scenario, we could be looking at increased property prices, but there are arguments either way. So ultimately, the reason that this has come into conversation now is generally the shift of the views of the Bank of England, as them recently saying that they wouldn't rule it out, or it's not something that they would not consider. And also, as an economic tool, if the economy isn't recovering at the speed that the government needs it to, it is something that could still happen. And if you see that within such a short period of time, we went down by 0.75 down to 0.1, we dropped 74 basis points. If that hasn't had the desired effect, the only move is to go more that way into negative territory. It's a very interesting time economically, so we will only know by watching this space. My name's Riz Malik, Director of R3 Mortgages, and I shall speak to you soon. Take care.